In this video, I want to show you how to put together a manufacturing overhead budget. So let's say that your company makes bottled orange juice, and I'm going to assume here that direct labor hours are used as a cost driver for allocating manufacturing overhead. Doesn't have to be the case. It could be the company uses machine hours or something like that, but we're going to assume direct labor hours are the cost driver, and so therefore to put together the manufacturing overhead budget, we're going to need the direct labor budget because that's going to tell us how many direct labor hours are used in each period. And we're going to do a quarterly budget here, Q1, Q2, and so forth. So we've got our direct labor hours for quarter one is 11,300. And so we're going to plug that in when we do our manufacturing overhead budget into quarter one. We're going to start with the number of direct labor hours. And again, if we were using machine hours or something like that as our cost driver, then we would need to use machine hours instead of direct labor hours. But we've got 11,300 direct labor hours, okay? And we got the information here from in terms of production and stuff to put together our direct labor budget from our production budget. So we use the production budget to make the direct labor budget, and now that we have the direct labor budget, we're making the manufacturing overhead budget. Now, notice with the manufacturing overhead budget, so we've got it by quarter here, 4 quarters, and what we're going to do, we're actually going to break it out into variable manufacturing overhead and then fixed manufacturing overhead. So let's just assume that the rate for variable manufacturing overhead is $5. Okay, so $5 per direct labor hour. So we're going to multiply the budgeted direct labor hours by the variable manufacturing overhead rate. And so 11,300 times $5 is $56,500. That is the total amount of variable manufacturing overhead for quarter one. Now, fixed manufacturing overhead, let's just say that that is $50,000 every single quarter. So for quarter one, the total manufacturing overhead, variable plus fixed, is $106,500. That's just the $56,500 plus the $50,000. Now, if we want to figure out, well, what are the actual cash disbursements for manufacturing overhead? What we want to do is take the total manufacturing overhead and then subtract the amount of that manufacturing overhead that is depreciation. Because remember, depreciation is a non-cash charge, right? So this doesn't involve cash. It's an expense, but it's not a cash expense. And so if we want to know the cash disbursements for manufacturing overhead, which would be helpful when we go to make our cash budget. So it would be $106,500, the total manufacturing overhead, minus depreciation that was in that overhead, is $76,500. That's for quarter one. That's how much cash we're going to spend on manufacturing overhead. Okay, and then quarter two, we repeat the process. We take the direct labor hours from our direct labor budget, and we use that. Then we multiply it by the $5 of variable manufacturing overhead rate, gives us $69,250. We add that to the fixed manufacturing overhead. We get $119,250, and if we subtract out $30,000 of depreciation, we get $89,250. Now we do the same thing for quarter three and quarter four. Now, when we look at annually, we think about, so let's say here we've got our total manufacturing overhead is budgeted to be $430,250, and that's not the cash disbursements. Well, let's leave aside the cash disbursements for a minute. Let's just look at the total manufacturing overhead budgeted for the entire year. It's $430,250. So if we take that amount and we divide it by our cost driver, which is direct labor hours, and our total direct labor hours is 46,050. So if we divide by that, we get our predetermined manufacturing overhead rate. Now that rate is including fixed and variable. Okay, that's why it's different than this rate for variable. $9.34. That's per direct labor hour. This is going to be useful. So you might be saying, why are we doing this? Well, what we're doing, we're calculating this predetermined manufacturing overhead rate because we're going to use it when we go to calculate the company's ending inventory balance and also its cost of goods sold. Because remember, that manufacturing overhead is a product cost. Okay, we've got direct material, we've got direct labor, and we got manufacturing overhead. These are all product costs, and so they're going to be used to calculate the ending inventory and the cost of goods sold. Cost of goods sold for the income statement ending inventory, which will be on the budgeted balance sheet, and so forth. So that's why we're taking the total manufacturing overhead here, and then we're using the total budgeted direct labor hours to come out with the predetermined manufacturing overhead rate that accounts for both fixed and variable. And this is the rate we'll use that will be applied to end up figuring the ending inventory and the cost of goods sold.